these every time we start over. Okay, so here we go. Toast to Traders. Thank you, Rob Hoffman, just off his 15th win, international and domestic, in trading championships. And that's no BS, people. And I actually wrote down on my paper here when he said, "What the deuce?" I'm going to use that for the rest of the season. What the deuce? Love it, love it, love it, love it, love it. Okay, so there's our lineup for today. Rob just went. We've got Price on deck, then Todd, Andrew, Josh, Larry, and John. I'm going to say this one more time, guys. We are already getting very close to capping out in here on the number of people that can attend. So if you're in here and you plan on staying the day, but you're going to step away from your machine for a minute, I suggest you don't log out, because you might not be able to get back in, and there's nothing we can do about that. You'll just have to wait for the recording. Okay, so Rob just covered his presentation. The next that we have up is my great friend, Mr. Price Healy. And Price knows all too well about what happens when you get locked out of the webinar. We actually did our kickoff event straight from Hubert Center's Bat Cave in Versailles, Kentucky, and that was last summer. And Price actually got locked out and had to drive over from Lexington and come into the Bat Cave with us and do the presentation right there with us, just standing side by side with Hubert, because there was no other way to get him in. So can't urge you guys enough to please just sit tight. Don't lose your spot. Okay, so I'm going to give Price the mic and make him the presenter, and we'll do a little quick test, audio test. Mouse is moving super slow this morning. All right. Price, give me just a second, because I want to make sure that my recording is picking up your...
Can you hear me, Jeanette?
I can hear you.
Good morning.
All right. And I've just upgraded Chris, and so let's make sure he can see what he needs to see.
Thank you so much. Yeah, upgrading my associate Chris Sayre, my lead consultant. So ready when you are, Jeanette.
Okay. All right. Let me switch my recording and make sure I'm getting your. Oh, let me move your screen just a hair. Camtasia, very tricky sometimes. Give me just a second, Price, and let me maneuver your PowerPoint here so I'm getting the whole thing. All right, looks like I got it. All right, Price. Everybody, welcome my good friend Price Healy. We've been friends a long time. I think we met in the early 2000s at a trade show, and been great friends ever since. He is the head honcho over at BigTrends.com, and I'm going to let you take the mic.
Oh, well, thank you so much, Jeanette. It's great to be with you all here today, and I've got my lead consultant, Chris Sayre, with me to help answer questions online. You know, we're going to talk market scanning secrets and talk swing trading, you know, how to set yourself up for swing trading success. You know, I'm always curious to know if you are grading yourself. I love to get you involved in these presentations. This will tell me that you can hear me okay. If you are grading yourself, I'm not going to name any names. If you're giving yourself from a 0 to 100 on a score of how well you have done in following a methodology this year, I'm not even going to say if you've maxed out, you know, your profit potential, but if you're grading, 0 is the worst you could possibly do, 100 is the best you could do in following your system. Okay, so we got a 5%, a 50%, a 60%. You know, I'm not saying you win. If you follow a system and you actually lose, but you followed your system, give yourself an A+. Okay, give yourself 100 if you followed it perfectly. So we got a 40 and 80, a 40, a 45. Haven't seen anybody say no system yet. I'm impressed that a lot of you apparently have a system. 5%, you know, 50, 60, 78.6%. Larry is very exact. Good to see you, Larry. Welcome, one and all. But basically, what I want to talk about is a more systematic approach. One of you said you're having trouble seeing the screen. I'm going to reshare it here just to make sure it's coming through loud and clear. And we're going to talk about, okay, how do you develop this systematic approach, and then how do you go scan for ideas? And the beauty of this, in my opinion, is that it makes us take our ego out of the game, our desire to be proven right. That desire to be proven right, you would think, is something that's going to drive you to success, right? I mean, I've been blessed with great education, graduated from Duke University, which around here in Lexington, Kentucky is a little bit of a true four-letter word. But bottom line is that I've been blessed with that great education, and then I came into trading thinking I had to be right all the time, and guess what happened? I couldn't actually let go of my losing trades quickly. I had to relearn that you can't be a perfectionist in the markets. You've got to follow an approach where you cut your losses quickly and let your winners run. So we're going to talk about that today. Just a reminder, of course, that everything I'm sharing with you today is for your information and education only. Even as I look at current market conditions and all the volatility we've had around Janet Yellen's latest rate hike here, we're going to talk about it in the context of just soaking in from an educational perspective, and I'll tell you how you can then take advantage of these signals from big trends. Ultimately, though, you know that you are solely responsible for your decisions in the markets here, and big trends and staff are not responsible for any trades you choose to make or ones you choose not to make. That's your choice, but we seek to be a resource for all traders to give you idea flow and then things you may want to be thinking about in any kind of market condition. Not all big trends products are appropriate for all investors, so consider what's right for you, risk versus reward wise. And we don't provide any personalized financial, tax, or legal information. We send it all out to everybody real time through email and text alerts. So then you decide how you want to use it. And it's tax season here. Consult with your tax advisor before you make any investment that might impact your unique tax situation. My accountant says after December 31st, he's just a historian. So it's a good time to look at making some investments in a lot of the different things that you're looking at here today across the Toast to Traders event. Check with your tax advisor. I know big trends products may be up to 100% tax deductible, and some of these other ones may be too. So check with your tax advisor, though. I'm not a tax or accounting guy. But basically, what we're going to talk about today is what's next in 2016. It is that time of year where you get to recap what's worked for you, what hasn't worked for you, and how can you learn from what's working and what's not to make further progress and make the next year here in 2016 potentially your best trading year ever. That's my goal, is to help fellow traders really push to new levels of success. What I want to focus on, I mentioned a systematic approach, but I also want to talk about support and resistance and how to define those automatically, okay, not just manually. A lot of you, like I'm drawing on this chart here, we're going to get into the actual charts because I know that's what a lot of you want to look at, but I got to lay some groundwork first. How do we do it automatically? How do we do it systematically so that we're not, I think that's a support level, and you draw a line in the chart, but then you look back and go, oh, this other level is actually much more important. I let the charts do it for me with the indicators that we're going to show you here today. We're also going to talk about stops. How do you manage your trades with progressive stops? You can't just leave your initial stop in there and just sit on it. It has to adapt to what the markets are doing. So we're going to talk about that and a number of chart examples from swing trades that I've done throughout 2015, so you can get some flavor on that. Now, I find a lot of traders, frankly, I know a lot of you are, the fact that you're here tells me you're committed to education. That thrills me because I believe it all starts with education. A lot of people, frankly, if you're going to try to hit a bullseye target, you pull out your bow and arrow, and if you're pointed in the wrong direction, guess what? You're headed in kind of all kinds of strange directions here. I want to get you pointed right towards the target and hit the bullseye, but you got to be educated properly first. You got to be oriented to that opportunity. Then we're going to talk scans. That's our topic here, and how to scan through the markets to find the best of the best situations through exploration. And then it's about having crystal clear precise entry instructions and exit instructions so you can execute properly. Okay, so we're going to focus you on that. And so here's the discovery that I want to share with you. I've been trading for more than 25 years, and bottom line is that I've traded a lot of methods, both things that I've created and other methods, as well as tested literally hundreds upon hundreds of different trading ideas, if not into the thousands now, that basically what works and what doesn't. And guess what I first find out is that most things that sound like a good idea, when you put them through testing, don't give you enough of an edge that you should be putting your hard-earned money to work in it. You need to find something that's got enough of an edge. So I don't have to have created it. I'll borrow from the past giants, and let's borrow from one where it really works. And this is an idea based on Richard Donchian's Donchian channels, which is basically defining what's the highest high of a recent period and the lowest low of a recent period, and creating a channel, a support and resistance band, if you will, or line of overhead. Where have we been and where do we stop, and down below where support. Now, of course, the markets are going to adapt to this, and you need to know how to adapt with it. The additional innovation that I think we added into it is filtering your signals based on the long-term trend. If you're in an uptrend, what I find is, here's an example here, within an uptrending channel, you know, markets have been uptrending for now 6+ years, right? And so you basically look at a situation where if you start in the middle of this channel here, and let's say that you go down to the support level, a lot of times what will happen, our system is set to buy the lower end of a channel and an uptrending channel because it can quickly ratchet up there, okay? But when it hits up to the upper channel, that does not become a short signal there. It becomes an exit signal. Because too often in an uptrend, it may come down quickly, but too often it'll do one of these, where it'll flatline for a while. Okay, and then it'll maybe have a jagged little pullback. But if you're short through that flatlining period, especially with options, you can't afford to actually be going sideways if you're buying an option. You have to be positioning yourself to just be waiting for the next buying opportunity in the uptrend. And likewise in the downtrend, it's just the opposite. It's basically, you know how you can quickly get these sharp downside moves here, right? And then you say, okay, but that's my exit signal, because then you get sometimes the L-shaped recovery, right? It doesn't go straight up. Maybe it goes sideways for a while and then it bounces. Then you get your next short signal within the downtrend, and oftentimes those will move a lot faster onto your target. Okay, so we're looking for being on the right side of that longer term trend. Pardon my graphic ability, but you get the, I'm not an artist, but you get the idea as a trader what I'm looking for, and we're going to walk you through why the systematic approach gives you such an edge. Now, I believe that more traders are losing money from the gut more because they're gut decisions than anything else. As I mentioned at the beginning, this is because of that dreaded three-letter word, ego. Your ego is costing you far too much money, okay? And our egos are so well trained from schooling and from prior careers and work environments where, hey, guess what? If you're right, you get promoted. If you're right, you get good grades. If you're right, you move to higher levels of achievement. But when you're in the markets and you're thinking, well, I did all this analysis, I'm going to eventually be proven right. This is where people make classic mistakes like doubling down on a losing idea. That's your ego trying to lessen the pain and lower what you think your average loss is when you average down. That's a huge mistake in trading. Never throw good dollars after dollars that are losing. The only thing that systems require when you add that other layer is some discipline. Discipline's a word that, frankly, turns a lot of people off because most people get into trading for the financial freedom, for being free from being your own boss, right? Not having somebody else telling you what to do, but basically doing it yourself. But with that freedom comes responsibility. If you're going to be a successful trader for the long haul, you've got to implement the right processes and disciplines to be better and better over time. Everybody's going to have times where you're not on your A game as a trader, but if you're following a system, the system will guide you through to stop you out, move you on to your next opportunity, and not get hung with a losing trader. I talked to far too many of our Big Trends coaching students who came in basically being stuck in positions. We can't have you be stuck. If you're stuck, then you're constantly asking yourself, what do I do next? That is incredibly stressful. It's not only probably costing you money, and because you'll typically take bigger losses than you should be, it's also costing you opportunity. You can't afford to basically really sit still and freeze. If you sit still and freeze, you're basically stuck in the past. Here's a good quiz for you. I'll ask you, I'm not naming names here because I don't want to put anybody on the spot, but let me just ask you, how often do you find yourself doing this? If you're a fairly active trader, when you get out of a position, this will tell you how much your ego is still involved. When you get out of the position, how much after you're exited the position do you go back and look through that day at that did you make a good decision or did you make a bad decision? Do you feel better about getting out there, or do you wish you had held on? If you find yourself doing that and constantly going back, if I was in IBM and I just exited IBM, how often do you keep looking at IBM later after you're already out of the trade? Don't be doing that during the trading day or during your opportunity moments. You want to look back to learn from your mistakes. That's right, William. You best do want to make sure you're looking back. But do that after hours. Do that in your regular recap phase. I do mine at the end of each week and at the end of each month in my off hours time. In trading hours, that's opportunity time. Don't get stuck looking backwards. Be in the present moment and focus on the future. To me, what answers that is a great system. Now, we're going to talk about, this is a passage to remind me to show you the current one on the SPY. We're going to talk about Donchian channels. And what you see here is we've got a short-term Donchian channel in white here. This is the lower Donchian, okay? So this is the lower one, and this is the upper one, the short-term highs here, okay, in white. You also have a longer-term one in blue, but our action signals are going to be determined against the short-term white Donchian channel, and then we're also looking at the long-term trend. You can see the long-term trend on this chart in yellow was graded as bullish. We were above it. Okay, so basically, if we had been below it, obviously down there, it would have been a negative. But we were above it, and so the idea is that okay, we've got an uptrending market. We want to buy dips in this market. You can tell where this was. This was earlier this year. Even as we would stop out on one trade, you can see it caught into another trade and caught this next snapback rally. That was earlier this year. We're going to look at the current chart here in just a minute. You can see some of these signals happen really quickly. Some of them, you know, the ultimate goal took a little bit longer on this next signal, but you can see if you're buying this dip, you could be positioned to then exit. This would be an exit. I'll put an X there, not a short. You see, well, gee, you would have made money shorting that market. Guess what? I don't want to short an uptrending long-term market. But if you're out of your trade there, then you could be buying back. It doesn't show a second signal here. You could be buying back if you're already out. It was still in on this trade station example. Here's another example where, you know what, you were wrong initially off this last buy signal for a couple of sessions. You know what? It's not hitting your stop yet. You're sticking with it. It was close to a stop, but it didn't hit it. And then when it tags up into the upper band here, you're actually booking a profit on the short term, at least for the quick trades I'm going to show you here. Let's look at the current market and bring this in up to date here, because we have had incredible volatility. You should be seeing this market through. You can see yesterday's close on the S&P right at 200.02, right back at the 200 line. Now, you'll notice that we're below the long-term trend line. We're actually, right now, that long-term trend line in yellow has actually been bisecting the highs and lows for the last month and a half or two for the S&P, okay? And so, we're going to show you this on a lot of individual stocks, okay? So the bottom line is that, you know, you really want to have a situation here in which you say, okay, you know, have a clear system, and you'll know. If you look back this year, it's been a very choppy year. That buy signal I just showed you on that last chart from March, even though we had such a tight trading range that it never hit the profit objective, you could have been in and out, back in, back out, back in at the lower channel, out at the upper channel, in at the lower, out at the upper. You see how many times you could trade around that really creates a much more of a swing trading perspective. Now, why am I sharing this Donchian channel methodology with you? It's all based on data testing. Okay, so if I go and look, this is the S&P, this isn't TradeStation, this is just a past data test going back to 1993 here. So we're looking at just over 20 years of data. And this shows you your overall equity curve buildup. The green dots show you if you would have been making new equity highs. What I think is encouraging is that even though this year has been choppy for a lot of folks, if you look at where we started the year, this equity was at what, 12,955, and then even with the last losing trade, it's up to 13,532. So it's made money even this year when the S&P is down. Now, how has it done that? Well, because it's been able to be short as well as long. And you see, going back 20 years, even though it's been mostly a bullish environment, look at that. The short trades have made almost as much money. These examples are before commissions. You always want to factor your commissions accordingly and keep your costs down. But look, the short trades have made almost as much money as the long trades, even though you've had almost half as many short trades, 72, as you have long trades, 134. This is over 20 years of data. Now, that doesn't sound like a lot of trades, and it's not. That's averaging about 10 trades a year on this SPY example. But what I want to show you is we can rotate that to individual stocks and other trading vehicles to rotate around the markets and get plenty of opportunities each and every week. We're usually making one bullish and one bearish trade every single week in this particular system we call Sunday Night Trader, that we put out the alert right at the end of the day Friday and do a video recap on Sunday, and you can get in Monday as well. So basically, what I also want to show you actually is if you think, well, 20 years isn't enough data, and the yellow line, Tom says, what's the value of it? It's basically that we're, you know, sorting out, not buying dips within a downtrend. You know, when the Dow was breaking down back here in August, a lot of people get seduced into buying that support. You see, well, gee, we're right at support, and it did bounce a little bit, but then it got absolutely hammered there. And this system was sitting here waiting to short the Dow when it had a bounce in the downtrend. It got short the Dow after that. That was right in front of the Fed meeting back in September, and you see it got short at officially 16,740, and then took the profit there at 16,070, down almost 330 points there. You know, I take that back, down about, take it back about 600 points, which is about a 4% profit target potential that we're usually going to, try to get if we can get it. Now, you see a couple of those as it rallied in October, it had to quickly stop out and move on because it was too firm through those. Right now, where would I say the markets are at? We're right at short-term support, but we're basically in a neutral kind of a trading range, slightly negative on the long-term trend line, which is settling down here. I'm not that bearish here. This is a seasonally good time for the markets. So we've been trading this kind of back and forth. When the markets sold off last Friday, the 11th, we were telling people, I was on CNBC Asia on Sunday night saying we're bullish. We were recommending Microsoft and Disney on that press appearance, and I said why we liked them for obviously multiple reasons with Disney, with the Star Wars release coming up. But bottom line is, look, you got this big bounce back right to the short-term Donchian high last Wednesday and Thursday this week. And so that's now where we're saying this is resistance. You should be ringing the register on those buys that you just made a few days earlier, and then now it slams down over the last two sessions. So the point of this recent activity is that, you know what, I call this the manic depressive market. It's a market where they hate it one day, a couple days later they love it, and then look, a couple days later, Thursday and Friday sell-off, they hate it again. The bottom line is that we will look for opportunities within that Donchian channel to trade around it, even when we're not getting an official signal because we're kind of bisecting that longer-term moving average in yellow. Tom said, how do we determine our profit target? Well, it's based on risk reward. Rob alluded to it in the last presentation. It's all trading, good trading is all about what's an acceptable risk for you to take relative to a reward level that you're targeting. So if I'm buying into support, my target is the upper Donchian channel, which can adjust. You see it was sitting there at 17,784, and it tagged it right there on Wednesday, and it touched it again. If you missed it Wednesday, it was touching again Thursday morning, but you have to be nimble enough to hop out when you see these things hitting, and you can't be reactive. That's probably one of the big lessons here. In fact, you're basically buying when everybody else is selling, and you're selling when everybody else is buying in a very short-term context, because the belief that I have, and Rob alluded to it too, why he looks at weekly and even monthly charts, is the daily chart's got a lot of noise. If you think the daily chart's got a lot of noise, if you're looking intraday, then you've got even more noise. That's why this system is optimized off of the daily chart. And I mentioned the Dow because this Dow example in TradeStation goes back 90 years. That's 9 decades of data. We're going back to 1925 here. And you say, why do I go back to 1925? You know, back in the early 30s, the Dow hit a low around 41. Dow Industrials 41. Okay, that's incredible, isn't it, now that we're up over 17,000? But what I think is even more incredible is this system has actually, this is of course based on a 90-year back test. I wasn't around 90 years ago, but basically we tested the data back as far as we could get it, 90 years in this case, and the short system still made money. Now you notice the win percentage isn't as strong on the shorts, and we can tweak this. If you want a really high win percentage, we can tweak it. It's just that you will affect the size of your average winner will get a lot smaller. The average win is 2.5 times the average loss on the shorts. So the point of this is that when you go back and you look at the equity curve now over 90 years of data, you see that it had some incredible runs. The only time it had a little difficulty is when we transitioned out of a 2-decade bull market at the start of the 2000s to about middle of 2002. You see we had a little give back there. I'm always looking for what's your drawdown phase, what might you have to endure on any given system, and you had to endure a little bit of pain there. Okay, that's why I don't care how much money you've made on a trading system or methodology, you never want to load the boat and stack too much of your capital into any one trade or even into a series of trades. You want to take a small and steady approach, wins the race. You might say, well, that means the bear market is not as good for this system. Actually, look, 2008, this system went vertical into the middle of 2009. So the point of this, and look, in this year you can see it's still made progress on the way up there earlier this year. It shows a bump down there because of that August period there where we basically saw that sharp drop. If you look back earlier this year, it was basically catching a couple of good quick pops, but actually it shows this trade is a losing trade. by the end of it, but as I mentioned, we were buying the dip, selling the rip, buying the dip, selling the rip. So bottom line is that, you know, there were loads of trading opportunities, even more than what the system actually shows, because it's looking for a profit target, and we're saying, look, if it hits short-term resistance, we're going to book some of our gains. And so let me show you actually how we do that. We'll come back and look at a lot more of these charts here. Want to leave time to go through that, but let me show you how we do this. Remember what I showed you is on the Dow and the S&P, for example, they didn't just make money on bullish trades. They also made money on bearish trades, even when the overall market environment was bullish. So what we do within our Sunday night trader system is we basically say, look, if we're getting a buy signal on Amgen, this is just an example of what we do. We'll show you some more examples more up to date here. That this one was in March. We said, look, we're getting a buy on Amgen. We'd already just put out a bullish signal in another trade, so we didn't want to load the boat there. But a week later, Amgen is still holding all the support here. Okay, so that Donchian line support is like a rock. So we were actually saying, look, a week later, we still are on a buy. It has not been stopped out. We want to get into Amgen here. It just so happened on that one that it made its profit target the very next trading day. And this is an example where when you get your profit target in here around 160 from the buy around 152.5 to 153, you say, well, gee, it went on to 170. I don't care about that. I'm playing the probabilities of our testing and saying, look, a lot of times we want to book the quick profit and be in and out before it then comes back down. You know, sometimes we hit our stop loss and we say you got to hop out. That's part of it too. So, you know, there's going to be winners and there's going to be losers. Typically, our profit target is twice our stop loss. That 2-to-1 ratio is what sets you up for even a system that's having a 40 or 50% win percentage will still make you money if you're making twice as much as you're losing. Okay, now on the other side, while we were getting the bull signal in Amgen in March, we were getting a bear signal in Pandora. Now, Pandora, of course, is the online streaming music company. And I'm not trying to be a fundamentalist here and saying, well, what's the fundamental business model look like? What I'm trying to do is say, what does a technical price action edge tell us about these type of plays? So when I go and look at Pandora, for example, and I go and look at that equity curve, you can see since then it actually just gave another sell signal on Thursday, right before the big drop there. But what I'm really paying attention to here is, that's a more updated chart, is this equity curve line, and more importantly, how are we making our profits? Well, in this case, Pandora is making profits on both sides, short and long. And then you compare the same thing to Amgen. Again, Amgen, more updated charts to show you what I go through each and every week. You see it's been real choppy like the Dow there, and not giving, it's bisecting on the long-term trend line. So we're not getting, even though you're getting buy the dip, sell the rip kind of potentials there, we're not going to take those trades if they're not as clear cut. But more importantly, look at the Amgen breakdown on where it makes its money. 95% of the money is made on Amgen on the bullish side. I'm going to be much more interested in bull trades and not as interested in bear trades when I go and look at that incredible overall equity curve buildup over time there, right? So that's really what we're talking about is, okay, if we know we have an edge on the bull trades, I'm not going to be likely to take these bear setups here because there's probably better bear setups elsewhere that have a higher probability of success. So that's how we kind of filter through each of these charts. I'm going to get into the scans here in a minute, but I want to show you what I'm going to be scanning for. Okay, now what we do within Sunday Night Trader is we used to put these out just on Sunday nights and get into the trades on Monday. We found sometimes we were right too quickly. And that's a good problem to have, but we just said we had to adjust, and let's put them out Friday afternoon, usually a couple hours before the close, no later than 3 p.m. Eastern, an hour before the Friday close. So we're getting signals right near the end of the week that we're then putting on. And what we do is we convert the stock signal into typically an in-the-money option. So Amgen was trading about 153. We were buying the 2 weeks out weekly 150 calls, had about 3 points intrinsic. We had to pay $480 for them. That's why we couldn't buy a month out. We usually will buy about a month out in time. And so on the other side, BTO means buy to open. So we're just simple option buying here. Pandora was trading about 16.5. We're buying an 18 put, which is worth about $1.50 intrinsic, and we're having to pay about another 50 cents or $50 a contract out of that $200. per contract as time value. So about 3/4 of the position is intrinsic value. That gives you a real stable base when you've got that kind of intrinsic value. You're not worried so much about time erosion. And these trades, I'll show you a number of examples here in a sec, are basically holding about a week. So, that's to me an ideal swing trader's horizon. Now, you see, we give you a specific stop if it trades under a certain level, and then what we do on the targets is we try to take a first half out at a certain profit target, usually 20 to 30% for the first piece, and then tighten the stop to break even. If I can get at least a 20% gain, you're going to usually see me going ahead and moving my stop on the rest up to break even, because at that point, even if you only made 20% on the first piece and then it gets stopped out around 0 on the second piece, you're still making some money on the trade. So it really increases your overall consistency. And if there's one thing that I ask my big trends traders here, and I know a lot of you probably sharing this, when you think about your 2016 top trading goal, I don't have a poll capability here, but I could guarantee you that of the top topics between making a lot of money, not losing money, being more consistent, and having more confidence, it's the consistency and the confidence that more and more people are telling us they're looking for. This gives you a lot of consistency too, because you're taking a lot of market risk out and you're saying, I'm going to have a call and I'm going to have a put on 2 different securities. We call that a pair trade. The traditional definition of a pair trade is being long and short 2 different stocks in the same sector. We don't really think that's the best way to go for this system, because we have a lot of different stocks and sectors that are giving us bull and bear signals all the time. And so when you go and look at, again, past performance is not a guarantee of future results, but you go and look at how the system ends up setting up, then you start seeing, okay, we get a call and a put typically each and every week. And so you start looking at, okay, what's that look like? There's going to be winning phases and losing phases. There's the Pandora and Amgen combination, which ended up being a good combination on both sides. The Amgen, we took the whole thing out at 69.7%. Pandora took the first piece at plus 30, trailed our stop up, and ended up taking the second piece at 7.5% gain. So the average gain on that one's about 18% or so, almost 19%. But the bottom line is that it's about taking a part of your profit, trailing the stop, and giving it a chance to be a bigger winner. Some of these will work out that way. Others will trail down and hit a trailing stop closer to break even or so. And there's going to be losing trades. What we've done in more recent times, earlier in the year, we were stretching as much as a 30% stop. What you'll notice is when we take it out to, as the year progresses, we've actually tightened the stop loss management to closer to 20 to maybe at worst 25%, so that you're seeing tighter stops and still having the potential for some of these trades like Wynn Resorts of 60 and then 80+%. So we're happy if we get a quick stop on Deer calls down 6%, and then the Wynn puts make us 60, 70, 80%. So that's the classic kind of pair goal, is that you keep your stop tight on the side that's not working, and you let the trade run at least part of the trade when it is working. And then you bring it up to more current examples, so you can see here, just you can kind of zoom in and see some of the ones through the June-July phase. And then you go on into the more current examples. I had to pack them in because this is from essentially where the market, hit that kind of slam down there, and you can see that basically you're going to have the potential, like that gold trade, GOLD, that's actually Rand Gold, is a gold stock, up 23, then up 53. And notice what I'm most pleased about is the stops. Keeping the stops small. Sure, you're going to get knocked every once in a while, but when you can have those plus 50s in other cases versus the minus 20s to minus 25 range, that gives you a chance to keep that 2-to-1 reward to risk target in place. Okay, so we'll show you some more of those examples. But what are the kind of stocks that we want to trade? What surprises people is I'm not trading so much of the Netflixes and Amazons in this particular system. I can trade those, but I usually save those for my weekly options folks. But basically, I'm looking, those are more volatile. I'm looking for more consistency here. I'm looking for that word, consistency is probably on most of your minds. More and more people are telling us that if you're more consistent, you can be more confident in your trading, because then you know how to manage a trade and not get thumped on some kind of a just volatile move against you. Sure, every trade has risk. You always have the possibility that you could lose what you put into an option purchase, okay? You have to go in understanding that. But at the same time, we want to manage it very tightly so that we take that out of the equation in the vast majority of cases, so that we can really then leverage a better average win versus our average loss. Notice Disney, I mentioned that one. We'll look at a few of these here, like Disney into the Star Wars launch here, and basically, and it'll show you exactly what I'm talking about why you have to follow this systematic discipline. Caterpillar, been kind of, Cat, we joke internally and say Cat is a dog. Cat has been a very poor performer this year, to where it's now going to be in the dogs of the Dow, one of the top 5 highest yielding stocks at the end of this year. So that Cat becomes a dog of the Dow that maybe that's historically been a value system to trade into the next year on the Dow stocks. But most of these are Dow stocks. McDonald's was left for dead at the end of last year. McDonald's has had a very positive year, up more than 20% in a market that's actually down for the year. So it pays to pay attention to some of those. Past dogs can become future leaders. Home Depot has been a monster this year. And then you see some of the ETFs like gold and SPY are still on our system. I mentioned Disney there because I want to show you an example of why I like Disney last week. I didn't like it so much in the middle of this week. And we're going to talk scans too, so we're going to come on in. The scanning happens because of the ability to have these very systematic buy and exit signals, okay? So when to get in, when to get out. We use TradeStation because it's where I can code decades worth of data and see what really works. So you're really getting the benefit of not just my 25 years of trading experience, but also the coding that I do on an ongoing basis to make sure we're in the best of the best type of approach. So I pick out all of these swing trades. Somebody once asked me, did I name myself Price to get into the investment markets? I'm actually the third. My family's been the thoroughbred horse business, and when I was graduated from Duke University, I told my dad I wanted to do something more conservative than breeding thoroughbred horses. I wanted to trade stocks and options, right? And he thought, you're nuts. And I thought, no, actually, I know I can manage my risk. I can get exactly in and exactly out where I need to in stocks and options versus in the horse business, they say breed the best of the best and hope for the best. Well, I didn't feel like hope had a place in my plans for how to build my equity. Okay, so basically what we do is we send out these swing trades through real-time entry and real-time exit alerts. We tell you when to hop in, when to hop out. You can actually even follow this through an auto trade with a few select brokers. You can check in with Chris Sayre, who's in with me to help answer questions about how auto trading works to help get you in and out automatically if you don't want to sit around and wait for when we send out the next entry or exit alert. But we're going to talk scanning here, and we're going to go into that scanning process and how we then come up with these ideas. And before I even jump into the scans for a second, I want to also show you, let me show you this real quick here. Disney, Star Wars just launched, right? This is why you don't trade on news and think, oh, Star Wars is going to be huge. I mentioned last week how I liked it because we were coming right back down as we headed into the end of the weekend, even though this prior signal had basically not really fired. I was saying, look, we're right into the long-term support line, and you got the launch of the Star Wars coming out next week. But look, it rallied hard, even harder than the markets rallied earlier in the middle of this week. Into Wednesday morning, we actually hit a new short-term Donchian high. That was resistance. That call that I made on CNBC Asia on Sunday night was saying that, okay, we're now going to book that. This is why we always tell people, if you're just watching these and not knowing how to trade them, that basically you shouldn't be trading them until you know exactly how to get in and get out. I give all my Sunday night traders a strategy video in addition to every week videos teaching why I'm in and why I'm out. Now you see what happened as it slammed down here, and you think, how could it be slamming down when Star Wars is expected to be so big? Well, because bottom line is that, expectations are already out there. Everybody knows that's coming out, and they're anticipating it right here, right? That's why you want to sell that the highs and hopes, if you will, and then you buy when everybody's sort of throwing it out the window with everything else, with the market sell-off that we had this week. So, but we're just underneath the long-term support around 110, so that's probably not an ideal one. Well, and I say, but Disney's been great over the long haul, so it's something that, look at how good Disney's been since 2011, just almost straight vertical until the last couple of little quick stop outs. So basically you say, well, gee, most of the money that Disney's made on the long side So it's something you want to pay attention to when Disney's a little bit firmer. But when I go and I look at scanning, there's a couple ways I can scan. But usually what I'll do, because I like to just get an eyeball at each of these, I can automatically sort and have it pick out for me the top few candidates. But I'm a big fan of just kind of going through the big name stocks. One of you asked about Apple earlier. Apple has not been acting right for a while, as you can see with this system here. It's been basically only giving us sell candidates because, and you see with this last one here, just booked a profit target from about just under 119 down to 114 here. Over, that one took a couple of weeks. But you see, even there, you got a first profit target hitting. Then it came back up and touched the upper band there in white, and then it slammed down again. Would I want to be shorting it right here? No, even though it acts very heavy, because basically now we're right down near the lower bands. So don't short near the lower bands. Be patient and wait for the bounce. And then when you get the bounce and everybody's kind of breathing a sigh of relief, then you can get some wonderful entry points. But right now, even as it breaks into the intermediate term Donchian channel in light blue, bottom line is that you don't want to be trying to short when everybody else is shorting there. Okay, you can see in comparison when it had been trending up earlier in the year, we'd had some really nice buy signals here. So the overall equity curve for Apple, again, shows you more gains on the bullish side than the bearish side, but Apple surprisingly hasn't been as straight up as you would expect on the equity curve for the system. It's had some straight up periods like 2014 to the beginning of this year, and you can see this year's been choppy and actually probably slightly down even with the recent comeback. So you can see it also had a straight up period 09 through about 2011, but it's had a little bit more chop than I would expect. So that's a little surprising to most people, but it tells you that, okay, Apple isn't going to be at the very top of my scan list. Surprisingly, compare that to a stock like American Express. When I'm going through the A's and I'm sorting this out, you can see AXP, I mentioned it even midweek to my subscribers, it wasn't quite giving the official signal. It touched right up into that short-term Donchian high, but basically it kind of did the same thing like it did back here. But you can see the official last couple signals, you can see, have been really, really good on AXP. It has played AXP to the downside about 4 of the last 5 trades very successfully. So you're not going to be perfect with this method, but what I look for is look at this equity curve on American Express. Look how steady that is. That's going back into the 70s. And you see, even when it's had a little give back, it didn't last very long. And you can see in this one, we ended last year, the equity on this system was at like $7,600, and now it's at like $9,200. So that's a very nice percentage pop in your equity for what's normally kind of considered a slow and steady blue chip stock, right? But it's been only on the downside. So, you go in and we mentioned stocks like Amazon. We don't really trade Amazon as much. And here's why, because while you see you could have made some quick money in Amazon on that last little couple of dips, when I go and look at the equity curve, Amazon's equity curve is all over the place. I don't want that kind of inconsistency, and yes, part of that's because it does not work well in shorts. It's worked pretty well in longs. So this would be a bullish-only consideration, but you're going to have to pay a premium when you trade Amazon like that, right? So what I do is I keep on rolling through. You've got names like Alibaba, which you see just had a quick profit here in the past week. But Alibaba hadn't been around that long, and you know what? It doesn't have that great of an equity curve. I mean, it's made 1 out of 1 on its bullish trades, and it's 2 for 8 and down on its bearish trade. So it's net not making money on that system yet. We'll give it some time, but you go and look at other big name stocks like Baidu, where you think, okay, Baidu's been pretty good. Even though it got a quick little stop out here, you look at it and you say, yeah, it's made money on longs. It would have been one that we would have been considering. We did not trade it. But you see its equity curve's okay, but you see it's on a little bit of a short-term decline here in its equity here in the last half year. Okay, so that raises some questions about, okay, are we in a little bit more of a chop phase for that? These wild and woolly stocks like Biogen, you see the biotechs have been very poor here this last few months. And so we go and look at that, you say, it broke down after it had been bullish most of the year through July. The trend totally shifted with a big gap down there off of the earnings in July, and now it's sell the bounces. And you see that overall, that Biogen has been a very steady one to the upside. But if you were long into earnings there, then you'd really have gotten whacked. That one shows a big give back. I don't recommend using the system right in front of earnings. Earnings is basically like a roll the dice crapshoot. I don't want to be rolling the dice. I want to be putting the edge in our favor. And when you trade, you see it had a buy signal right before earnings and then got caught on the wrong side of it. That's what shows that equity drop. I wouldn't have been taking that signal right in front of earnings. I think that's a mistake. Sonny has a good question. He says, which type of option you're buying? We're tending to recommend something that's more in the money. So let's look at one we just recommended. I'll show you exactly how we did it last week on Facebook. Okay, so with Facebook, what we did, and remember, we do the put call pair. So what we said is, okay, we had a call on Facebook, and we're out of this now, so this is not a recommendation, but just showing you, for example, what this looks like. Okay, so we even send a follow-up in case you missed it on the Friday update here. We'll send a follow-up to you that says, okay, look, we were getting into, and these are not recommendations anymore, so do not consider them as active. They're both closed. We're saying buy the Facebook January 97.5 call, and we'd like to use it, buy them out into January. And we had to go more in the money with this one. The stock was trading up in the 103-ish range, and we bought the 97.5 call, well in the money for $760. That's $760 for a contract. You know what, even if you can only get one contract, to me, that was the preferred play than trying to buy a more aggressive option, because the aggressive options had a lot more time risk in them. We gave a very specific stop if it had a trade under 6, and our first target was at $9. We also bought SodaStream puts, and that one did not work as the market raced up early this week, and we quickly stopped it out from 250 down to under $2. Said bye-bye, hop out, and move on. So that one didn't work, but we made up for it with Facebook. But here's why you have to be nimble. Because there's where the buy signal is happening there last Friday the 11th. We were trading actually 102.12 at the close. I want to show you something else, which is that you can do the same thing with an option chart. You can say, you know what, if I looked at the January monthly options, that's a January 15th expiration, and it was a 97.5 strike call when we recommended Facebook. That's where we were recommending it, right on that line there, right on this dip. You say, how could you want to buy it right into that what looks like possible breakdown? Remember we said get in up to 760. It finished the day at 710. If you missed it on Friday, you can still get in at Monday's open at 720. Now remember we said $9 was our first target. It actually flipped to 9 by Tuesday. Okay, so we went up on Monday and then hit our first target at $9 on actually 9.10 on Tuesday's open. So what do we do at that point? At that point, we say, okay, we need to send a follow-up instruction to not only trail the stop up, but also give you another place to say, where do I expect to hop out? Now, yes, up into that resistance of that Donchian channel, we could say, yes, we could go ahead and consider getting out there. It was 10.25 at that peak. It closed at $10 that day. It closed at about $10 there on Thursday as well. But you know what? We said we're going to give it a chance to trail on up to our ultimate objective closer to about 11. It hit 11.30 back here, so we thought we could get that. You know what happened in the markets? The markets dove, and so we had a trailing stop in place, and our auto brokers told us they got out at an average of about 8.95 here. Okay, so we still were able to protect it. We got out at 9 on the first piece, got out about that on the second piece. So this is where trailing still gives you an opportunity to let a profit run, but if it doesn't work, good thing we got out there at 8.95, because you can see it went down to 7.95 by the end of the day. So this is part of the plan, is that if it's working, you give it a chance. If it's not working, you get out and move on to the next trading idea, okay? Now, and again, I've got just about 5 or 6 more minutes, and I want to keep us on schedule here. But I want to tell you how you can actually take advantage of this. And so what we've done for you is we've set up something that usually I would only do for my in-house existing paid subscribers here, okay? And so let me show you this, because it's the holidays, and we did this holiday special for my existing subscribers this past week, but I'm going to honor it for the Toasted Traders in a way to say happy holidays to you and set you up for not only next year, but actually with this BOGO special that I've got, I'm going to actually set you up to get an instant double on your subscription time and actually end up getting 2 years for less than the price of one. Kind of insane value here, but let me just show you how this works. Or you can just try it for a month at a time if you want to do that. That's cool too. So basically what we do, usually the lowest will take the 1 month auto renew, which is just every 30 days it just bills out at $69 a month. And if you want to cancel it, if it's not for you, you're in for the first $69. After that, if you want cancel in the first 30 days and say, it's not for me, I don't think you're going to want to. I think you're going to be real happy with it. So I think you want to stick with it. You're going to say, wow, this is far too cheap of a price, getting this much value, getting about 8 trades a month that are, giving the potential for up to 50% type of gains typically with tighter stop losses. But bottom line is that, at $69 you can try it out for a month. But here's the really insane special. Some will think I've lost my mind because services like this often sell for thousands, and basically usually the list price on this one's $995. So the 2-year value would usually be $1,990 if you bought it off of our website. But today I'm giving you the opportunity, and over the weekend, because we'll send it out in the archive as well and honor it through the weekend. But you want to get in now because of the new batch trades are waiting there for you. The newest call and put trade I just did at the end of the day yesterday are sitting out there for new subscribers ready to get entered on Monday morning as well. Bottom line is that you get 12 months of Sunday Night Trader marked down to just $595 from the usual $995. And what I'm doing here is I'm adding another 12 months absolutely at no additional charge, free to you. When you buy the year, you get the second year free. Now, the bottom line is that we call that BOGO, buy one, get one. And bottom line is that averages your cost. And think about this for a second. If you look at what you're going to get every single week from me, you're going to get 2, not 1, but 2 new trades at the end of every week. And again, it'll be reiterated with my Sunday night video that comes out and recaps everything I was looking at with those trades, plus the past trades. You're learning every single week. We call it learn while you earn. But you're getting 2 new trades every week for not just the next year, but with the BOGO for the next 2 years. That means that you're getting more than 200 trades with this BOGO special for just $595. They get your average cost per trade, can you believe this, under $3 a trade. I don't know how to make it any more attractive than that, and I can't, and that's why I'm going to pull this offer after the weekend. So make sure you take advantage of it very, very quickly. But you can see a number of the examples of trades that we've scored on here just in recent months, and basically you can just get some flavor that this is not a home run approach. This is more of a steady build of equity that we're after with this approach. And again, there's going to be losing trades along the way, but the strength of what we do is we constantly keep you updated with any existing positions where you need to tighten your stop, where you need to take a new different target profit, and then move on to the next opportunity. Okay, so the bottom line is you go to that page. It's bigtrends.com/Sunday. So bigtrends.com/Sunday will get you to that special page. I want to come in and answer a couple questions and look at maybe a couple other, maybe we'll just do a couple other rapid fire. If you want to type in a few symbols, I'll do a few of those in the last few minutes. Why not do a call debit spread Pete on Facebook, because that will limit our upside. It keeps it a lot cleaner. What account size do you need? You don't need a big one here. We're typically recommending, if you recall what we were just looking at, let's go back to that for a second. If you recall, we were looking at in terms of typical entry price on these recommendations. They're usually at $500 or less, give or take. So, we tend to say, like on a model portfolio of 10 grand, that would get you at least on 10% allocated, typically at least a couple of contracts per trade. So you could peel one off and then have the other one to peel off later. That's what we typically recommend, that you can get yourself in that position. We wouldn't do it starting within the $1,000 account size, because you don't want to overcommit yourself on any one trade. I like to see you in the neighborhood of about 10% or less of your capital allocated to each new trade. You can do what you want, but when you start committing more, you're going to create a more volatile profile for yourself. And this system, you can see steadily, even in a down market year. So basically, that's what we're looking at there on that approach. You can go back and look at other past examples too of the size of gains versus the size of losses. And that's what it's about, is putting the reward versus risk in your favor. Let's look at a few charts real quick, because I'm getting a few of those coming across, and then we'll hand it back over in a few minutes to Jeanette. So basically, Netflix. Netflix obviously has had a huge run, and you see this last signal here. It was a buy the prior Friday, a week ago from yesterday, at 118.91, hit the profit target intraday at 124. Now you see, you've got to be nimble, because then guess what? It's right back under 118.91 at 118.02 with the market sell-off. So you see how these adjust. But yes, Netflix has had quick pops, and when you're wrong, it quickly stops you out. You see, maybe a little early there because it did end up flipping back up. But you know what? We can't afford to hold and hope. We've got to have a plan. If we catch it right, you get a big snap up, like a coiled spring, pow, right back up to the upper Donchian channel. yes, it carried on through there. I don't care. I'm only going to trade from the support and then get out back at the resistance. I'm not going to go short either because it's above the long-term trend line. You can see that's been the case for all of this year. You can see the last time it was below there was back in January, and that was right before earnings. Wouldn't have taken that trade right in front of earnings. And you see it had a couple of quick stop outs, and you say, so how has that looked on its overall strategy performance for Netflix? Well, surprisingly, you would think Netflix would have been good, but it's made money on longs, it's lost money on shorts, and the equity curve is all over the place. After a really good run where we would have liked it a lot, as we were seeing these green dots back in 2010, haven't liked it so much here in the last few years because it's all over the place on your equity. Is that what you want your portfolio to look like? It's not what I want my portfolio or my subscribers' portfolio to look at, so I tend to stay away from Netflix in more recent times. Even though it would have made us some money, I want more consistency. So when I go back and look at, in comparison, other names that we've traded, you know, if you think about, you know, just slow and steady, like McDonald's, I mentioned, is having a real nice year. Well, you know what? You could have only been long on McDonald's here, and you can see the last McDonald's signal that was a while ago was back on November 13th at 110. Boom, snap it to 114.37. You know, so the bottom line is that, you know, Mickey D's has been a steady as she goes type of stock this year. Even this one that shows a stop, you see you buy the dip, you should have been selling at least part of your position into that bounce. We would have trailed our stop and probably gotten out at break even or so on the rest off of that trade and still made money on that trade that for the rest of people would have been a stop out if they're not following a disciplined approach like what we're showing you. So long-term support line in yellow, yes, you have to really look at it. What about Bud? You know, thinking of the holidays there, huh, Paul? You can see Bud, you know, if I look at Anheuser-Busch, you see that equity curve does not appeal to me. It's just basically all over the place. Just not something that I really want to trade when it's just chop city, right? So we don't really have that one on our preferred list. And so, you know, you go back and you just look through as we're scanning through a variety of these. You know, I go in and these are ones that, you know, we're constantly looking at what's our next opportunity. You know, so like when I looked at Facebook, and I popped that one up, and I was saying, well, you know what? The equity curve had shown a little give back on the prior signal, but you know what? We were saying that was also tied to, you know, the bear trades don't work on it, but the bull trades have been very, very steady. So that's the kind of thing that we're looking for, is that equity curve build out that can also help build our Sunday Night Trader subscribers' equity as well. Okay, so that's how we scan through and just basically keep flashing through those. So even a market like gold that's been such a poor performer, you see, well, we got into that short on gold right when it came off of there, and you can see. So when again, how does this look? What are you getting with the Sunday Night Trader system? If you're getting my very clear-cut instructions about, okay, where we have a new trade set up, how we want to get in, how we want to get out. Okay, so we'll tell you exactly what we need to do. So with gold, we said at that time, we said let's get into the gold December 109 put a couple weeks ago on the 4th, 3 weeks ago now, and I guess 2 weeks ago. I'm getting ahead of myself. That would put us at Christmas. Bottom line is we said that's a 109 put at 530 or better. Okay, so when we're getting into that put, let's go look at that for a second. With the put option chart, remember what it, and then I gotta hop because I gotta make room for our next speaker here. But with the put option chart, we'll say, look, you know, we're getting into the this was the December 109 put, and just look at that little line that was right there. That's where we're getting in. When everybody else is sort of losing their head, we're not losing ours. We're saying we want to buy into that there, and then we sell it into that snap up. Okay, even though it went a little bit higher, we're very happy to say thanks very much, Mr. Market. Let's take that opportunity from the lower Donchian to the upper Donchian and say bye-bye to the trade. So remember, because I started about 5 minutes late, I'm going to go ahead and hand it off back to Jeanette here in 1 minute at 5 after here. Basically, that remember, you know, go to bigtrends.com/Sunday. What that's going to get you is not one but 2 new trades, the pair trade approach with a call and a put every week. You don't have to worry so much about what's going on with the market and its manic depressive gyrations. You can say, look, let's find the best call and the best put in different stocks, different markets each and every week, and then we can balance out our exposure and then take advantage of it whichever way the market chooses to swing, even though we know we've got a market edge too with this system. So all you do is you go to that page, and then if you want to get the 1 month at a time auto renew, it'll auto renew every 30 days for just $69 every month. Then just click on that text and left click on that. It'll pop that right up for you. You put it in your shopping cart, hit the green checkout, and you're good to go. Or if you want to do the best special, buy the year, get the second year all in one-time investment of just $595 for the next 24 months. You just hit the add to cart for that BOGO special, and you'd X out whichever one you don't want, hit the green checkout, go through and fill out your information that'll fill out once you hit that green checkout in our cart. So without further ado, I'm going to hand it back to Jeanette. Wish you all a very Merry Christmas and a happy holidays with that BOGO special. You can't beat it. Definitely take advantage of it. It's our best pricing ever, and I think you're going to really enjoy the Sunday Night Trader system for 2016 and 2017 with that 2 years for the price of one, or go a month at a time. So thanks for being with us, everybody. Hope you enjoyed it, and you can always contact us through our 800 Big Trends line, and if you ask about the Sunday Night Trader through the phone, do mention you saw it on Toasted Traders, and we want to always make sure to give them credit for doing such a great job hosting these. Jeanette, thanks so much. I'm going to hand it back over to you right now.
Thank you, Price, and everybody give Price a big round of applause for being with us on this beautiful Saturday morning. I say it's beautiful because it's beautiful here where I'm at in Mobile, Alabama. Let's do another roundabout. Tell me where you're from while I do my housekeeping here. And don't forget that Price's offer is bigtrends.com/Sunday. So I think he made a pretty special offer there for y'all. He's in it for the long haul. This guy's been around a long time. He ain't going anywhere. So Kentucky. Kentucky in the house. John Crawford's in Lexington. So you're probably right there where Price is. Canada, Huntsville, Alabama. Hey, Tim Huber. I am Jeanette Sims, and I am in Mobile, Alabama. There's our schedule for today. Let me go ahead and flip over my little recording here.